Well, we're here on Thursday morning before the market opens. John, once again, we have got the US market providing direction for the rest of the world. Had a very steep recovery over the last 4 to 6 weeks. Is this bear market over? Are we past the worst now that Trump has instituted an agreement with China?
Well, it's work in progress, Paul. So the correction in the market has happened, and now we're re-correcting up, so to speak. I think there's volatility ahead. I don't think we can deny that. We've got almost like peace for 90 days between America and China. We have to work out whether they will get a resolution. So it'll be interesting to see whether we get updates or whether we just find out at the end. I think the other thing which is buoying the market is Trump's very pro-growth at this stage. He's travelling the Middle East, and I almost think he's the commission agent for Boeing. The number of deals he's doing selling jets. I hope they've got the capacity to supply all these jets, but you have to say he's doing a good job in that respect. And obviously he's selling a lot of arms, which is interesting. And no one's sort of focused on that. He seems to be doing a lot of deals for defence capability of the Middle East, which is interesting given history there. But to answer your question, the market's recovering, but I don't really think it's got a lot of upside during the next 90 days.
Yeah, John, some good economic data out of the US in the last few days, in the sense that the inflation data is coming back to their target. So we haven't really seen a spike in inflation because of this tariff scare, and that must be reassuring to the markets. On the other hand, the market was expecting up to 3 to 4 Fed cuts for the rest of the year. Now that seems to be back to either 2 or 3. What are your thoughts? And in the meantime, bond yields seem to be creeping steadily upwards.
Yeah, well, look, as you've often said, there's hard data and soft data, and there's forward data. We're looking at hard data, which is the past, and inflation was not apparent pre-tariffs. There will be a kick in inflation. Most commentators and economists are suggesting the June quarter is where you'll start seeing it. We've got a 10% tariff increase and still 30% tariffs on China, so it will start filtering through in the forward numbers. I think the big win has been the oil price, which has come back dramatically under the Trump administration. It seems to be holding in the low 60s, and that's flowing through the gasoline prices and the cost of moving goods in America, so that's positive. It's unlikely that inflation will go below 2. It's more likely in America it'll head back towards 3, which goes to the point where should the cash rate settings be by the Federal Reserve. They're sitting on their hands at present, waiting for more data. They'll want to see some hard data probably around June, July, looking back on the effect of inflation, on the effect of tariffs on inflation. So it's work in progress. And I think the point is right. We won't be seeing 4 interest rate cuts, unlikely to see 3, 2 maybe, but there is a confrontation developing between the Federal Reserve and the Trump administration, which I'll be writing about in my letter to investors shortly. And that's going to be interesting to see how that plays out, because clearly Trump wants interest rates down. Low interest rates does have some effect on inflation. The cost of borrowing does go into the cost of production. So he's going to be pushing hard on that. But whether the Federal Reserve relents, I would suggest is unlikely at this stage.
John, let's switch to Australia. The RBA will meet next Tuesday and is virtually assured to cut interest rates by 25 basis points. So over the last week, we've seen Aussie yields in the bond market rising. We've seen iron ore back above 100. We've seen the VIX down. We've seen gold down. Are we getting back to a position where, because of the agreement between China and the US, the Australian economy is going to be more or less protected from the tariff wars?
Well, look, I think there's good signs coming out of China. They've put out some releases yesterday which were very positive and seeking support from Australia in terms of regional stability and regional trade, which I thought was good stuff. And there's a meeting going on in China now between Brazil and China, and China's being a big benefactor, supporter of Brazil. China seems to be more outwardly looking, merely it's trade focused, and Australia will benefit from that. If they're successful on their trade engagement with or around America, that's positive. And I think we said that all through this whole tariff debate, Paul. I think we've been saying that the effect on Australia is not as significant, or the direct effect is not as significant as the market was suggesting. Regarding interest rates, which you mentioned, I mean, it's interesting when the market went full throttle on interest rate cuts at the May meeting. It was during the tariff issue. That there was an argument, and particularly by national bank economists, who said, look, there's such distress in the world given this tariff that we need to cut interest rates by 50 basis points, not 25.
Yeah.
No, I'm not saying there won't be an interest rate cut next week, but I keep on saying I don't think there'll be many this year. From a central bank perspective, they'd be happy that the Aussie dollar is tracking up towards 65 cents. They don't want to see that momentum stifled, because that will bring inflation back on imports, and Australia's a big importer of goods. Having said that, the US dollar is beginning to weaken, and that flows through to the bond market, which I know we're going to talk about. But back to your specific point, I think things are okay for Australia. I think we're looking good. And I think the government, with its mandate, and I'm reading about education today, about the minister there. He wants to push more capital into the education sector, the public school sector. I think you'll see a more, for want of a better word, liberal approach by Labor to start spending money in key parts of the economy. And given they've got the 3-year mandate, expect the budget deficit probably to weaken in Australia. But we shouldn't be concerned about it. America's got a 6% deficit. We've got a 1% deficit. If we went to 1.5%, would that really be an issue for Australia if we're growing and can stimulate growth at 2 to 3%? It wouldn't be. So that's where I'd leave that one.
Yeah, well, that's interesting. So now that the election's over, Labor's got the mandate. You're suggesting that we have more of the same, but there's nothing to be too worried about. I was just looking at the numbers this morning. I've noticed that according to Goldman Sachs data, the market has gone in the last month from being on a PE multiple, a forward multiple of 17.2 a month ago during the depths of that sell-off. It's now at 18.6. So we fully recovered whatever rating we had before this whole tariff turmoil. Is that fair value for an economy like Australia? And in the light of the banks being a big part of our market, and the CBA coming out with a quarterly, CBA is on 27 times. Where do you stand on that?
Well, it's not. The share market's not great value, and that's why I maintain my view that we can invest in the Australian corporate sector, but maybe we should be looking more at debt and convertible debt rather than pure equity in big slabs of it. Unfortunately, the index is dominated by the financials, and the financials are dominated by Commonwealth Bank. So you've got this magnification through weighting of the PE average. I guess if you did a proper, an equal weighted average, the PE would be lower, if you know what I mean. Because I think the PE is driven by Commonwealth Bank and probably by the resources sector, who arguably have a reasonable outlook. If China can reset with America and China can build trade relationships around the world. And that's going to be one of the issues, I think, developing out of this US tariff war, so to speak, is push China to more aggressively trade with the rest of the world. And that's not bad news. That's good news for Australia. And we know Europe is sort of on a rebound as well. So Australian market, it's not great value. I always say just try and buy value inside the market. It is difficult. But when we can generate 6 and 7% yields through corporate debt, that's a pretty big hurdle for the equity market to try and match. Now, the equity market's always forward-looking. And as I said in an earlier answer, I think the outlook is getting more positive than negative for Australia. So that puts some momentum into forward estimates of earnings growth. But it's sort of pushed back by the fact that the banks are struggling to grow their earnings. And Commonwealth Bank's third quarter announcement yesterday, up about 1%, on a run rate, not much happening. If you look at quarter on quarter on quarter, there's not a lot happening. The good news, if there was some, was that the Commonwealth Bank is pushing more into business lending.
Yeah.
And that will improve its margin. And, Australia needs its commercial banks to start funding the corporate sector. They've been very absent from that market for capital adequacy rules, but also by direction. And that's let the private credit market appear. It would be good to see the banks go back into that market.
So, John, you're suggesting that corporate debt's a good place to hide when market valuations are stretched. And I know you've spoken in the past about looking for yield. How do you assess the other opportunities for yield, such as REITs and utilities and so on? Is that where Australian investors who are kind of cautiously positioning themselves should be investing in right now?
But I think there's another aspect, and everything you say is correct. We need to look right across the yield market and assess the risk of the underlying asset against the quality of the cash flow and the certainty of the cash flow coming to the investor. So that's the job of the analysts, and that's our job as managers in that part of the market. So, there's not a lot of opportunity in infrastructure, frankly, in Australia. The REIT market is recovering, but it's very volatile at present. We hope, and this will be the spur to the property market, if interest rates do come down by 50 basis points, we will see in the next 12 months a lot of these property funds and their management teams renegotiate debt with the banking sector and their debt lines, and that saving in interest will flow through to higher yields on the equity. So that's where the REITs are probably recovering, and why they are looking to recover and why they will recover in 2026. So that's not a bad place to be. But then you've got to start looking at the segments. Probably, shopping centres, big boxes, industrial to an extent are probably more better places to look than the mid-city commercial, although there is a little bit of activity in commercial, but I think there's a bit of a workout happening there. So again, segmenting the market, and the yield is better in Australia. That's the other point. If you look across the Western world and look where bond yields are set, Australian bond yields at 4.5%, which is your bellwether, that matches America. So you're not getting the currency risk by investing in Australia, and it's a good 2%, 1.5% to 2% above Europe, and 3% above Japan. So Australia's yield is pretty darn good. And one final aspect, because there's a lot of discussion happening, I know our investors are interested in the superannuation changes. One aspect of the superannuation changes is it will drive that high superannuation accounts will be driven more to income investing and not growth investing. Now, arguably, that's where they should be when you think about it, because if you're running a pension fund to pay a pension. So there might be an interesting aspect here with people with, 3 million plus in their super, in their pension, will do rather than panicking as much as some people are suggesting, redirect their investments more to income generation, because you're not going to get massive capital gains there, are you? So you're going to get income, which you can pay out to yourself and manage your balance.
That's a very good point, John. I don't know that I'd really thought that through, but you really want to avoid a volatile asset in your super, because you don't want to be paying tax on a big increase and then 6 months down the track, all that increase which you've paid tax on has disappeared.
Yeah, exactly,
So
and that's where we play. That's what we play for. Clime's more a focus on sustainable income than anything. That's our forte, and particularly over the last decade, where momentum trading in the equity market has taken the world away from value-based investing. So, I think strategically we're in the right space, and our clients should come and talk to us about redesigning a pension fund very much focused on sustainable income, which meets their needs as a pension, and satisfies or takes that volatility out, which you talk about, so we don't get this capital gains issue developing.
Yeah, I think that's an excellent point to end on, John. Thanks for that, and we will see you next week.
Thanks.